Capitec Bank has announced a 72% increase in headline earnings to 489 million rand in the 6 months to August, up from 284 million rand in the comparative period last year, which translated into headline earnings per share of 520 cents, an increase of 53% over the 340 cents reported last year.
Capitec market cap now up to 17.6 billion, price earnings at 21, dividend yield at 2. Johny, let's come to you first in Cape Town. When you run through the numbers from Capitec, I mean, they're all double-digit. They're all just really, really impressive numbers, growing fast. We've even seen the debts go the right way. Doing my digging today, I'm trying to find something that perhaps should worry us. I mean, the market is saying it looks good, nothing to worry about. Are we missing something here? Or is this a bank that's currently really just in that sweet spot?
Look, a very impressive set of results, as you mentioned. I guess the only thing that you would be concerned about with Capitec is just the increased competition that seems to be entering the unsecured space. Citigroup put out a very good report about a month or two ago, just sounding the alarm bell that we may be actually entering a bubble in the unsecured space. A lot more competitors. I was trying to think of the number of competitors now in the unsecured space on my way here. It's probably about 10 to 12 major players now who are playing in this unsecured space. And the players themselves are taking a lot more risk in the space. So if you look at Capitec's results, the average term of new loans in the comparable period, 21 months, up to about 31 months at the moment with the launch of their new 60-month product. So just a lot more risk entering the space at the moment.
Yeah, and there was a comment staying with you in Cape Town there, Blue Financial Services, who once were a high flyer, saying that the South African market is in a sense overtraded. And what you're suggesting there is part of that overtrading means perhaps a little bit of lax, reducing in terms of regulations and who gets the money, maybe being a little bit easier in giving money to people, which is potentially going to mean that the debts, which are bad debts and impairments, are looking good. Those could start to turn ugly down the line, maybe in a year or two.
Correct. As the competition intensifies, the risk is always for one player to start to cut the price of loans, or as we've seen now, to extend the term of the loans. So both Able, Capitec have launched this new 60-month product. There's quite a lot of risk that is associated with giving somebody an unsecured loan for 60 months. And that I don't necessarily think is priced into some of these stocks. If things were to go wrong and the global economy hits another speed bump and unemployment in South Africa begins to ratchet up again.
Turning to Drikus, now joining us here in Johannesburg. Drikus, they're not looking cheap relative to the big banks. They've got quite a lofty premium, and Simon mentioned the PE ratio and the dividend yield. How do you feel?
Yeah, I'd rather look at price to book than the PE ratio when it comes to banks. And they're trading, I think, about a 5 price to book at this stage. But with the ROE that we're seeing at the moment, and a depressed ROE because they issued 1.1 billion rand.
Yeah, they did that rights issue back in January.
Yeah, ROE of 29%, which actually should be nearer to 35% if it wasn't for the rights issue. It does justify the price at a price to book of 5 if you consider the bank, or if you allow the bank to grow at, I would say, 25+% over the next 5 years at least. Being said that, it is a microfinance here at the end of the day, and there is a lot that can go wrong. But to the risk side, what we have to understand is the last 3 years haven't been a friendly labour market. These guys are more sensitive to a downturn in the labour market than they are to an interest rate environment. And they've achieved these results in view of this actually depressed labour market. I would be surprised, or I'm looking forward to seeing what they can achieve, in a boom time. In a boom time, with actually some more, more accounts being opened. Having said that, they open 19,000 90,000 accounts a month still. If you compare that to later talking about Altic, I think Autopage added 30,000 for the year, and then I'm not that scared paying a price to book of 5 for the share. Having said that, there is a better way to own capital or to get exposure to that, but we'll get to that later in the show.
Hot Stoxx, I know where you're going with that. Coming back to you, Johny, in Cape Town, one of the things they got, cost-to-income ratio of 46%, compared to certainly if you look at the big 4 banks, they're sitting around the mid to high 50s. Those numbers blew out over 2008, 2009. I know Jacob Maria on the station was saying he's not sure we're going to get back to the sort of 51, 52s. Is that 46%? Obviously, it works hugely in their favour. Is it because they're more micro-lender, or is it because they came late into the game game, 2001, and are completely electronic. PC and quick to, the back office is much simpler, much more efficient.
Look, I think there's a couple of things at play here. I think also for microlenders, I think you also need to look at cost to advances because their bad debts to advances is significantly higher. So if we just use African Bank as an example, they've been able to bring the cost plus the bad debts to advances below sort of 20% to advance, and that's probably a number you want to look at because African Bank's got a 10% bad debt ratio, where Stan Bank's only got a 1% bad debt ratio. So it's also how you sort of slice and dice the numbers. But obviously, your big banks, your four major retail banks in South Africa have massive infrastructures which they need to cover, which Capitec and Able are probably never going to get to that kind of scale because they've joined the game a bit later, and technology can take care of a lot of those things.
Well, we'll be moving on to Able later. Drikus, give us your view on Capitec. Do you think it's a hot stock or not?
I think it's a hot stock. I'll be reluctant paying these prices, but Capitec hasn't made much chance for you to get in the last 3 years. You had your chance back in 2008, 2009. I think it went down to about $20. That's your last chance when you had it. It hasn't retraced by, I think, more than 20% since then. There's not been a time where I said, okay, this thing is trading below P or 50 and I feel comfortable buying it here. So if you want to get in, I wouldn't wait for the share to come back. But also from a portfolio perspective, I won't overweight the share. Keep it to a certain percentage. It's still in a very risky market segment. But I think you can label it as a hot stock.
Hot stock for Drikus, just go overweight. Johny Lambridis in Cape Town, how do you feel about Capitec? Hot or not?
Unfortunately not. I just think it's really just too expensive, and with the sort of headwinds which we see coming for the unsecured market, we'd look for a significantly lower entry point into Capitec.
Not hot for Johny, too expensive. Simon, how do you feel about Capitec?
First, the disclaimer, I own it. And I bought it way back when it was a lot cheaper. I had to sell a lot because, to Drikus's point, I became overweight. I mean, the stock was up 400% or something crazy. So I sold a whole bunch of it. I like it. I think it's a great stock. I think it's a great story. I think it's a hot stock. It's expensive. I don't think it's ever going to be cheap. It's got momentum on its side, but it seems to have paused around the 170, 180. When it starts to move again, it could easily get to the 240. I think if you want a little bit of risk, and make no bones, this is expensive, and that brings some risk. Small little stake in Capitec, sure, hot.
Hot for Simon. We now turn our attention to African Bank. As a first mover in offering unsecured lending to the lower end of the South African market, African Bank has a fairly entrenched position in the sector, but competition is becoming more aggressive.
African Bank's got a market cap of 27 billion, a price earnings of 13, a dividend yield of 5.5. Johny, again, let's come to you in Cape Town first. African Bank, in the micro lending, a couple of key differences. One of them, they don't take deposits, so they have to, Capitec gets the deposits, which is essentially a cheap source of funding. They've got to go and find their own funding, typically in the bond market. How much does that hurt them, or is it not such a big issue, really?
Look, I think they've got a very good track record now in the bond market. They're a very big credit issuer. We don't own the equity, but funnily enough, we actually own the debt because the debt is quite attractive relative to what you can get on the Govy yield curve. So, I think long term, they probably might suffer by not having a sort of a retail deposit franchise. But in the short term, it hasn't really hurt them to date.
Let's come to Drikus now at the table, and I really have two questions in one. The first sentence around the acquisition of Ellerines in 2008 for 9.1 billion rand. That is really not performing well. And secondly, if we're taking a look at the dividend payout of the company, it's been on a downward trajectory since 2008, 2.10 rand, 1.85 in 2009, and 85 cents in the 6 months to 2010. So if we know that Ellerines isn't performing and attributing to group performance, and we know that the dividend is on a downward slope, why would we even hold Able anymore?
Well, for the hopes they can turn the model that we know works. It works in the States. Not one, well, if you look at the perspective, let's say, from other competitors in the market, Lewis, for instance, they've not separated the finance side from the traditional retail side. In the US, there's not one retailer they've left that has not separated the two businesses, because what you tend to do is the finance side tend to subsidize the traditional retail side, to spur sales on the finance side, and that doesn't work anymore in the Western markets. And I think Ellerine saw that they knew they had to get a partner to move their book over to, and you know was kind of a reverse listing actually, and you know JD has done the same thing, and JD as well has had some strain in implementing that. I think once they've laid the groundwork and we're in a better economic environment, I think the dividends you talk about will start escalating quite nicely, but we're not in that environment yet.
The dividend yield, as someone mentioned, is sitting at 5.5%, but that's because the share price has been under pressure.
Exactly, it's a dividend yield. Well, nominal dividends I think will pick up once the economic environment picks up. You know.
Johnny, your take on the Ellerines, when they announced it, I thought, crazy, they're bankers, they're going into retail. And in retrospect, I understand that, in fact, Ellerines was probably more bank than retailer, as was JD and many of the others. It was challenging for them, but certainly it's helping them with footprint. They're putting kiosks into 180 stores. They're looking to get it to 300. It's almost they're buying a book and a branch network. Your take on the Ellerines deal?
We didn't like the Ellerines transaction. We actually owned Able pre the deal and sort of sold out post the deal. I do think though that they are now over the worst of the Ellerines sort of teething problems. You know, we're talking about the dividend. They have held the dividend constant for 2 years at 185 cents. You know, I think consensus again is around that level for the current year. The year end is September, so they'll report sometime in November. I think there is a slight chance that we'll see a slight increase in that 185 cents annual dividend. You know, but you know. Able has been a very good dividend pay. You know, 6% divi yield is sort of nothing to be sneezed at in the current environment.
Johnny, you mentioned that you hold the debt and not the equity in Able. They've got a R1 billion bond program with the London Stock Exchange. Capitec, on the other hand, has got a 1.3 billion rand domestic bond issuance. What is your take on some of the risk factors that they're facing from borrowing on the bond market, apart from currency?
Look, your biggest risk is obviously that the funding just dries up, and you know there was some kind of risk of that back in 08. You know, ultimately your funders decide that you know they want to pay up a lot more. They want you to pay up a lot more for the funding, so you'll get squeezed on your margin. But you know, a similar thing can happen with a retail deposit base. We saw that with Samba spectacularly in 2001, 2002. Where you had very cheap funding from a retail deposit base, but you know the retail guys just fled, and you had a run on the bank. So Able effectively can never really have a run on the bank, but they would have to pay up tremendously for funding in some kind of a bear scenario.
Johnny, the Consumer Protection Act, which came in effect April of this year, does it have any impact? Does it play in that space of the micro-lender, the unsecured lending space, or does that still all fall under the National Credit Act?
Look, Able is hurt by the sort of CPA on the Ellerine side of the business, where effectively you're selling appliances and furniture, and effectively the customer can sort of put back those those items to you if they're not happy with them for a sort of 6 or 12 month period. The traditional lending business is really more governed by the NCA, which came out sort of 2007.
Drikus, I want to bring it back to you. Ellerines, I was reading some of their presentations on the website. They're doing a heck lot to really revitalise it and differentiate the different brands, and really saying that furniture retail in this country and white appliance retail had become stagnated and lacked enthusiasm and the like. They're really making it into something supposedly a lot better, a lot more exciting, a lot more profitable. Maybe they spin it off one day?
Well, we have seen something like that before, but actually they've got no excuse. You know, since the recovery began, if I might call it that, you know, furniture retail or durable goods has been growing at double digits in this country, and we've seen Lewis do fairly well. We've seen JD's turnover figure pick up fairly well, and Ellerines have been lagging them. Yeah, so they do need some enthusiasm, and I do think JD's Steinhoff deal coming through, I think there's a lot of new innovations coming through in that space in a few years' time.
We spoke about the risk factors around the bond market borrowings, but just looking more domestically, some of the risk factors they face with here at home. We mentioned Capitec previously. Postbank is hoping to get their banking license soon. They can't really do much around the loss of employment for people here in South Africa, but as far as the borrowing is concerned, they've got like really exorbitant interest rates, so that's one of the ways that they can mitigate their risk. Any other red flags we should be aware of as far as Able is concerned?
Able, well, the biggest red flags will be the bond market. If parallel parallel shifts, parallel shift in the bond market. They have to roll over the debt all the time. If you issue a 12 months or 24 months bill, you have to reissue one in 12 or 24 months time. You have to roll that over, and if your business increases, you have to increasingly roll over bigger amounts. And if you've got a parallel shift in the yield curve, which might happen, there's a lot of money printing going around. One of these days, I don't know when, we are going to have inflation again, and you will see massive shifts upward in the yield curve, and that means the funding will be much more expensive than it currently is. So keep that in mind. But I still see for that whole sector the employment picture as the more riskier element, and at the moment is subdued, so there's an upside to that.
And Drikus, all of those risks notwithstanding, would you say Able is a hot stock or not then?
I would actually say if the economic environment improves, I would like to own some Able. I don't think they'll do badly.
You'd like to hold some if the economic environment...
I've got other picks in the sector, yeah, but
he's hedging his bets.
Clearly. Comes with a caveat. Let's come to Johny in Cape Town. How do you feel about Able? Hot stock or not?
Not at these levels just yet, but I do think it's getting close to there. I mean, they should deliver about R3 of earnings for the year to September. Price is hovering around sort of 32, 33. Sort of a pullback to 30 would probably give you a sort of an entry point into Able on a P of 10, and not a bad dividend yield, but not at the current levels. Not
at the current levels for Johny Lambridis. You hated the Ellerines acquisition. How do you feel about Able overall?
Look, I got Capitec. That's enough micro lending for me. They're cheaper. I think they're cheaper because of Ellerines. I like the dividend yield, and I know the boys at Vestact are all over this one. They absolutely love it. Ellerines just doesn't inspire me. It worries me, and I think that Capitec's doing the full banking service. So I would rather go with them. So I would rather say Capitec, hot but expensive. Able, a little less expensive, but not hot.
We're going to be saying goodbye, Johny Lambridis, but before we do, Johny in Cape Town, let's get your hot stock pick and tell us why.
Well, I guess we're talking financials today, so if we just look at the financial space, I would probably look at the sort of beaten down, unloved stocks. Both of them at the moment sort of UK listed, so I think being tainted by the malice that we're seeing in the UK, but I think Old Mutual and Investec on sort of very low multiples. At the moment, and on a 3-year view, I think offer a lot more sort of value than some of the stocks we've been discussing today.